Hi everyone, for the participants already in the meeting. So we will be starting the webinar at 4 p.m. Paris time, which is in a bit more than 1 minute.
Hello.
Good morning, good afternoon, good evening, or good night, depending on where you are. My name is Gert van Dender. I'm with the Center for Tax Policy and Administration at the OECD, and I have the pleasure of welcoming all of you, a very large number of you, to this webinar on the economic impact assessment of the global minimum tax. So thank you for tuning in. This is a welcome on behalf of the team. So the team will be presenting a lot of material in the next hour or so. After that, there will be time for Q&A. There's a lot of ground that we would like to cover, and we will very soon get down to business. But let me first share with you a couple of points on housekeeping before we start with the substance of the work. Matters of housekeeping are very brief. First, on the recording, this webinar is being recorded. It will be made available on the OECD website after it's finished and has been prepared for sharing, which should be in 24 hours or so at the longest. Q&As, there will be time after the presentation to have questions and answers. We would like to ask you to submit your questions not in the chat function, but in the Q&A function of this meeting. That's easier for us to work with. In terms of documents, we will be making available the presentation that's going to be used in this webinar right after the webinar. There's also a working paper that we will be talking about in the presentation, and that is already available if you would want to look at that. So these are the points on housekeeping that I wanted to share. After that, well, these are the speakers for today. Top left, that's me. We have Piers O'Reilly, who is the Deputy Head of the Tax Policy and Statistics Division and leads the Business and International Tax Units at the Center for Tax Policy and Administration. He will speak after me. Then we have Laura Arneman, who is in Piers's team, and she will speak to the results of the economic impact analysis. And we have Felix Hugo, who is also in Piers's team and who will speak about some early ex post work. So these are the people that you will see appearing in that order today. What is the ground that we would like to cover? This is the agenda, an overview of the Globe Rules, the side-by-side package, and the impact assessment work of the Global Minimum Tax, GMT, to date. When we say side-by-side package, it's maybe useful to clarify what we mean by that. This is the package that was agreed in January of this year. So it includes the SBS, the side-by-side safe harbor, and the SBTI, substance-based tax incentives safe harbor. So that's what we mean when we say side-by-side package. We will share after that overview an update of the economic impact assessment model after the side-by-side package. And we will share some early results from post-implementation data. This is based on data for single year 2024, so does not yet include the side-by-side package. Once we've covered all of that, we will go to Q&A, so do feel free to share your questions. And then we will work with those to organize the discussion after the presentation. The next slide summarizes results, and that will be the last one that I speak to before handing over to Piers. The key results summarized on this slide. So this is what will be developed in much more detail after this. First, from the update to the economic impact assessment model, 4 types of key results. First, on effective tax rates. Effective tax rates, we estimate, are going to rise by 2.8 to 3.7 percentage points on average at the jurisdiction level. Rates in investment hubs, we estimate a larger increase by 5.5 to 6.9 percentage points. So that's one key result, with the expectation that increases will be larger where pre-GMT rates are lower. We also expect that ETR, effective tax rate differentials, are going to fall by 19 to 25%. ETR differentials matter for investment. They have an impact on where investment is located. So if these differentials narrow, then we expect that this is going to be conducive to a stronger weight of economic factors in the allocation of capital. Therefore, an improved, more efficient allocation of capital can be expected. Profit shifting then. So the global minimum tax is estimated to lead to a reduction in profit shifting, a substantial reduction of between 22.6 to 44.6%. Global tax revenues, we estimate that these are going to increase by 3.2 to 5.4%, and that's expressed in US dollar billions there to 91 to 155 billion per year is what that translates into. So that's the ex ante impact assessment. The key results, much more detail, will come in a few minutes. We will also share with you after that results from an early exposed analysis, as said, on 2024 data, 2024 financial data. And this analysis suggests positive ETR impacts of the global minimum tax with no evidence of a negative impact on investment and employment. So we will explain how we come to these results and what they look like in much more detail. That's the very quick summary, all of that in much more detail now, and I will hand over to Piers first.
Thanks, Kurt, and hello, everyone. So I will briefly give a bit of background on the global minimum tax, which is probably well known and very familiar to most people attending this webinar, but I'll try to draw out a few features that are going to matter when we come to look at the modeling that we've done and the results. So if we just go to the next slide, a brief summary of the key elements of the global minimum tax. It's established by the GLOBE rules, and it's based on a common tax base and based on an effective tax rate that uses financial accounting data. It applies to large multinationals. So what do we mean by large? Those with revenues above 750 million euro. It works as a top-up tax to reach a rate of 15%, and it does that by applying top-up tax on profit that is subject to an effective tax rate below 15% until that profit goes up to 15%. At the same time, that effective tax rate, which applies on a jurisdiction by jurisdiction basis, treats specific kinds of tax incentives in a particular way that may allow the use of certain kinds of tax incentives to reduce the effective tax rate without giving rise to top-up tax. So in the years prior to the application of the side-by-side package, We had a specific treatment for tax incentives like qualified refundable tax credits, qualified marketable tax credits, whereas after the side-by-side package, we also have a revised treatment for other kinds of qualifying tax incentives, and we'll talk about that later. But that's going to be an important feature that we'll discuss today. The minimum tax doesn't apply to all profits. It only applies to excess profits because there's a substance-based income exclusion that carves out a certain share of profits in proportion to the amount of substance an MNE has in a given jurisdiction. So what do we mean by substance? We mean payroll and tangible assets. So that means that if you have high levels of substance in a jurisdiction and you have low tax profit, you may still not pay any top-up tax so long as the ratio of profit to substance is below this substance-based income exclusion. That substance-based income exclusion is there to try to target the application of the global minimum tax on BEPS activity on shifted profit. So where there's profit that's not tightly located to substance or not in the same jurisdiction as economic substance, the minimum tax binds more strongly than it does on other jurisdictions that might be more substance heavy, where the minimum tax will bind less strongly. In other words, it means that low tax profit after the application of the global minimum tax will continue to exist, but it will exist most strongly in jurisdictions that are heavy on economic substance. And so the SBIE has been a part of the design of the global minimum tax since its inception. But an important new feature that comes with the side-by-side package is a special treatment of substance-based tax incentives, which again strengthens the link between economic substance and the application of the global minimum tax. And we'll talk about that later on. The global minimum tax then has a specific rule order in terms of the application of top-up tax. First, a local or affiliate jurisdiction can levy the top-up tax through a qualified domestic minimum top-up tax. Next, a parent jurisdiction can levy a top-up tax on any profit that's not already subject to a QDMTT. And then finally, any low tax profit that might be subject to the minimum tax that hasn't already been collected by a QDMTT or an IIR can be collected under the UTPR by other jurisdictions where a given MNE has economic activity. So that's the specific rule order. That rule order is going to matter a lot later on in the results. It's going to matter for the side-by-side safe harbor because of the application of QDMTTs to MNEs headquartered in jurisdictions that are eligible for the side-by-side safe harbor. And it's going to matter as well for the rest of our revenue estimates, where, and I'll talk about this in a moment, the implementation of the global minimum tax is going to interact with under which rules the top-up tax revenue is being raised. And that means then it's going to matter for those jurisdictions that are experiencing revenue gains as a result of the application of the minimum tax. So that's the key elements of the minimum tax that we'll talk to. Turning next to the next slide, just taking a step back and looking at the work that we've done on the minimum tax so far. So obviously this tax is years in the making. We're 2 years into the implementation journey now. But of course, in terms of its conception and development, it goes back much longer. So from 2019, the start of the two-pillar approach, the blueprint in 2020, the agreement in 2021, and the publication of the model rules, the start of implementation in 2024 of the QDMTT and the IIR, the UTPR began implementation in 2025, and the side-by-side package, including the substance-based tax incentive safe harbor and the side-by-side safe harbor, were agreed then at the start of 2026. All along that implementation journey, we have worked to try to carry out economic impact assessments and put those results in the public domain. So we released a first impact assessment in 2020. We updated that then via webinars in 2021 and again in 2023, and then again in the start of 2024. So we've tried to keep up to date with the latest developments in the rules and tried to use those developments to revise our estimates. And then we're able to do that a further time after the latest developments as regards to the side-by-side package. But we're also, as Kurt mentioned, able to publish early results from the first year of implementation in 2024 from the consolidated financials of the in-scope MNEs, and Felix will talk about that later. So then turning to the next slide, just in terms of where we are with implementation, We have about 55 implementing jurisdictions in the central record for 2024 and 2025. Implementation patterns differ across jurisdictions. Some jurisdictions have only done a QDMTT. Some jurisdictions have done the full set of rules. It varies by jurisdiction. But as Laura will discuss later on, we are now using the specific implementation data as part of our modeling. So in previous public impact assessments, we've made kind of hypothetical implementation decisions to try and make an illustrative example of what the outcomes of the minimum tax might look like under different implementation assumptions. In what you'll see today in the core results, we don't do that. What we're doing now is we just take the implementation status as it is now and try and see what that might mean for all of the results that Kurt previously discussed. Of course, the implementation of the tax itself is not the only kind of response that might give rise to, economic outcomes. Some jurisdictions, for example, have decided to implement through domestic minimum taxes that aren't qualifying. Some jurisdictions have reformed tax incentives. Some jurisdictions have raised their corporate tax rates. There's different ways that the global minimum tax might prompt jurisdictions to respond that might result in behavioral changes that we might want to take into account for our model. And so that'll matter then when we look at the results, because especially in the 2024 early financial data, we don't know exactly what of the changes result from the direct application of the tax and what happens from more indirect behavioral changes, either by jurisdictions or by multinationals. So turning then to one key area where we're updating the results. There's a lot of different updates go into the results that you'll see today, but a key area that we're trying to cover is the side-by-side package. So as Kurt says, this is a package of results or a package agreement that was agreed at the start of this year, but it covers several different features. So even though it's called a side-by-side package, the side-by-side safe harbor is only one element. We will work to cover the side-by-side safe harbor and the substance-based tax incentive safe harbor in these results. But there's four elements to the agreement that it's useful to talk about. We have a previous webinar that goes through the package in detail that's already online that you can see for further details on these elements, but I'll just go through them briefly. So looking at the side-by-side safe harbor, what this tries to do is to accommodate different systems of minimum taxation on a side-by-side basis where those different systems achieve equivalent outcomes. And what it does is it limits the application of the IIR and the UTPR to MNEs headquartered in eligible side-by-side jurisdictions. So for our purposes, the only jurisdiction that is side-by-side eligible on the central record today is the United States. So we model the application of the side-by-side safe harbor to US MNEs. And so what that means for our purposes is that we switch off the IIR and the UTPR for US parented MNE groups in our modeling. What we do as part of the work also, though, is to continue to model the application of qualified domestic minimum top-up taxes for side-by-side jurisdictions. So for our purposes, that means that the QDMTTs still apply to US parented groups, and that's going to be important for our modeling in terms of what's driving our results, and we'll talk about that later on. Other elements include the simplified ETR safe harbor. We don't model that because that's quite difficult for us to do given the available data for us. And next, we do model the substance-based tax incentive safe harbor. So what this does is it introduces a favorable treatment for qualifying tax incentives. This favorable treatment is linked to economic substance, and it's only available to specific kinds of tax incentives. So expenditure or production-based incentives, where the amount of money or the amount of benefit that an MNE is deriving from that tax incentive is below a specific cap that's based, again, like the SBIE, on the level of economic substance. And that cap is equal to 5.5% of payroll or depreciation or 1% of depreciable assets. So Laura will talk about that in more detail, but we basically essentially work hard to model the economic impact of that substance-based tax incentive safe harbor. And we find that that's as significant a change to the results as part of the overall side-by-side package as the side-by-side safe harbor itself, not least because the substance-based tax incentive safe harbor is applying to the entire system. So it's applying to MNEs that are headquartered anywhere in the world, whereas the side-by-side safe harbor is only applying to US MNEs, and that's going to matter later on. The final element of the package is the evidence-based stocktake to take place in 2028 and 2029, which we won't touch on further in this presentation. So with that, that concludes my brief overview, and then I think I'll pass to Laura, who will walk us through the modeling.
Yes, thank you, Piers. So I'm now going to go into more detail on how we incorporated changes introduced by the side-by-side package in our economic impact assessment model and talk you through the updated results on the following slides. On the next slide, I will discuss how the current release compares to the last release of results. The last release of EIA results was in 2024 in form of a working paper as well as an accompanying webinar. In the current results, we made some important changes regarding the sample period, the modeling of the SBIE, implementation assumptions, and the incorporation of the safe harbors introduced through the side-by-side package. We also made some updates to the model more in general. The data in the last release covered a sample period from 2017 until 2020, whereas the current release is based on data from 2019 until 2022. It's important to note that while we have data in the current economic impact assessment for overlapping years compared to the old economic impact assessment, such as for the year 2019, this is not necessarily the same as the data from the last economic impact assessment. This is due to the fact that we have received some updated CBCR data, for example, for the years 2021 and 2022. And the addition of this updated CBCR data for later years allows us to make backward extrapolations, which can improve data quality for earlier years. We also changed the modeling of the SBIE from year 1 to the year 10 SBIE. The year 1 SBIE is more generous, allowing for the deduction of 8% of assets and 10% of payroll from the GMT tax base, while the year 10 SBIE allows for the deduction of 5% of payroll and 5% of assets from the GMT tax base. In current modeling, we focus on the year 10 SBIE, since it is currently the fourth fiscal year of the SBIE phase-in, and the model focuses on rather long-term effects. Since the GMT has not yet been enacted for previous assessments, we had to make assumptions regarding implementation in the previous release. In that release, we built different scenarios in which either all countries would implement or in which countries would implement with a certain probability. Since the GMT has now been adopted, estimates in this release are based on the current implementation of countries, so countries that have implemented any element of the GMT as of June 2026. It is important to note that changing the implementation assumption primarily affects to which countries the revenue gains from the GMT are distributed, but changing the implementation assumption has limited impact on the overall amount of the global revenue gain. Further, we also account for the latest globe developments. So the last economic impact assessment was carried out before the side-by-side package, so did not include a modeling of the substance-based tax incentive safe harbor or the side-by-side safe harbor. We also made some changes to the modeling more in general. So in the 2024 impact assessment, we accounted for GILTI revenues, which we continue to do, but we also extended our current economic impact assessment model to include subpart F and branch taxation as well, since these are relevant parts of the US CFC system. We also updated our profit shifting estimates to account for the effect of qualifying side-by-side regimes on profit shifting. This means that we take into account that US firms in low tax jurisdictions are already subject to taxation through the US CFC regime, and that these CFC revenues can be credited against QDMTTs. Accounting for this means that introducing a QDMTT in a low tax jurisdiction will reduce income shifting to these jurisdictions to a lower extent than in our prior modeling, since these companies experience a lower increase in ETRs than before due to the fact that we account for the fact that these companies are already subject to taxation. In the next slide, I will go through how we integrate these updates more in detail. The baseline modeling is described in detail in the working paper, which has been released in 2024. In the course of this webinar, I will try to provide a high-level summary of our modeling. Overall, we assess the impact of the GMT in 4 steps. First, we estimate ETR distributions based on aggregated CBCR data, complemented with additional data sources such as US BEA data. In this step, we also account for the impact of the SBTI safe harbors on ETRs, which I will discuss later more in detail. In a second step, we then estimate the global distribution of profits, assets, and payroll at the jurisdiction pair level, resulting in what we refer to as data matrices. Each cell in this data matrix reflects a jurisdiction pair. We update the profit, payroll, and asset data to the latest years for which CBCR data is available, so 2022. And we also account for the fact that the distribution of profit across jurisdiction is impacted by MNE profit shifting. When we estimate such changes in the location of profit due to changed profit shifting behavior, we account for behavioral responses to the safe harbors introduced through the side-by-side package. For example, we model that the SBTI safe harbor reduces profit shifting after the GMT to substance-heavy low-tax jurisdictions less than to low-tax jurisdictions with little substance. In the third step, we estimate the share of profits which are subject to top-up taxes. This calculation is based on the estimation of the distribution of ETRs that we obtained in the first step. And again, we account for the various safe harbors which have been introduced through the side-by-side package. In a fourth and final step, we distribute the revenue gains through top-up taxes across jurisdictions that implemented the GMT, depending on whether they implemented a QDMTT, IIR, or UTPR. Our baseline estimate is reflecting current GMT implementation. This means that we don't consider any potential future implementation or that countries that have adopted the GMT might abolish it. For illustrative purposes, however, we also show how revenue gains are distributed under a scenario in which all countries that have not qualified as a side-by-side regime implement the GMT. The next slide contains more details on how we model the side-by-side safe harbor. So as Piers already mentioned, to date, the United States is the only country listed on the central record as having an eligible side-by-side regime. This means that US MNEs continue to be subject to the US system of CFC taxation, so to be precise, NCTI, subpart F and branch, but are not subject to an IIR and are exempt from the application of UTPRs by other jurisdictions. At the same time, US MNEs remain subject to QDMTTs levied on their foreign profits wherever a jurisdiction has implemented a QDMTT. Top-up taxes levied via QDMTTs can then be credited against US CFCs. And for this, it is important to note that if $1 of QDMTT is credited against $1 of US CFCs, we do not consider this to be a revenue gain in our model. We also account for the fact that the side-by-side safe harbor can affect the profit shifting from jurisdictions that fall under this side-by-side safe harbor. In practice, this means that we assume that US MNEs reduce their profit shifting towards investment hubs that have implemented a QDMTT, similar to MNEs headquartered in other jurisdictions. What's different is that we assume that US MNEs do not reduce their profit shifting towards investment hubs that have not implemented a QDMTT. So the profit shifting response to the GMT now differs depending on the type of hub for countries that have implemented a side-by-side safe harbor. We also changed our modeling by assuming that some profit of US MNEs that was previously located in QDMTT hubs is not shifted back to the headquarter or another non-hub jurisdiction. Instead, this profit is rerouted towards investment hubs that have not introduced a QDMTT. So a reduction in profit shifting to QDMTT hubs by $1 will now only exclusively go to non-hub jurisdictions as in our prior modeling, but a fraction of this dollar will be rerouted to non-QDMTT implementing investment hub. For non-US MNEs, we will assume that the side-by-side safe harbor does not change profit shifting responses compared to previous modeling. On the next slide, I will go into more detail on the modeling of the SBTI safe harbor. Under the SBTI safe harbor, qualified tax incentives, QTIs, can be added back to cover taxes up to a cap equivalent to 5.5% of payroll or depreciation, or 1% of depreciable assets. Modeling the SBTI safe harbor is quite challenging since there is no comprehensive data on QTI availability and QTI use. So our analysis is based on limited information on QTI availability that we have collected through desk research, as well as data on expenditure on R&D tax incentives, which is available for OECD and partner countries. To reflect the substantial uncertainty surrounding the SBTI safe harbor, we modeled two scenarios based on the cap for the add back to cover taxes. In the first scenario, the upper bound scenario, we model that covered taxes only increase by 10% of the cap, and only in jurisdictions where a QTI has previously been in place, which are currently 114 out of 222 jurisdictions. In this scenario, the increase in globe ETRs through the substance-based tax incentive safe harbor is relatively small compared to a scenario without the safe harbor. And it is important to remember that the lower the globe ETR, the higher the top-up tax revenue. So in this scenario where the increase in globe ETRs is small, this means that top-up tax revenue is rather large. So this is an upper bound of revenue estimates. In the second scenario, the lower bound scenario, we assume that covered taxes increase up to 60% of the cap in all jurisdictions, regardless of whether they currently have a QTI in place or not. The 60% scenario assumes a larger increase in covered taxes due to the SBTI safe harbor, so a larger increase in globe ETRs, which will then result in lower top-up tax revenue generated. So due to the higher increase in globe ETRs in the second scenario compared to the first scenario, revenue gains in the lower bound scenario will be lower than in the first scenario. We also account for the change in globe ETRs through the revised treatment of QTIs when we model profit shifting responses by adjusting post-GMT ETR differences. In the next slide, I will talk a bit more about the caveats and limitations of our approach, which need to be kept in mind when we interpret the results of our modeling. There are some general caveats which apply to the current model and also apply to previous versions of the model. So one limitation of our model is that we rely on highly aggregated jurisdictional level data, and we're not able to account for any MNE specific outcomes. We're also not able to perfectly approximate the globe tax base, since the tax base in our model is primarily based on CBCR data. While we are trying to make some key adjustments, such as for the treatment of prior period losses, these are again done at a high level of approximation. There also might be various dynamic effects to be expected in response to the GMT, which we can only model very partially. One thing we account for is the changes in profit shifting by large MNEs. However, there might also be other behavioral responses, such as, for example, a relocation of substance in response to the introduction of the GMT, which is outside of the scope of our modeling. In addition to these general caveats, there are a number of limitations relating more specifically to the modeling of the side-by-side safe harbor and the SBTI safe harbor that need to be kept in mind when our results are interpreted. With respect to the side-by-side safe harbor, modeling the interaction between the existing US system and globe taxes is challenging, in particular since we only have aggregate data available. The tax base for the GMT is very different to the tax base for US CFCs, and modeling of these differences can only be approximated in the economic impact assessment model. On the next slide, I will speak a bit more about the caveats when modeling the SBTI safe harbor. One of the challenges when we model the SBTI safe harbor is that we cannot account for firm heterogeneity in our model. This is a general issue, but this is really exacerbated here. As mentioned before, we need to make strong assumptions on the use of QTI since we do not observe them in the CBCR data. And one of these assumptions is that all firms profit to the same extent from the add back of covered taxes. However, if there's heterogeneity in the use of QTIs, and this assumption is not true, our estimates could be biased. For example, if substance and QTI use are concentrated in low tax firms, meaning firms that have an ETR below 15%, covered taxes relevant for the calculation of the globe ETR will increase more than in our estimates. This means that we are underestimating the globe ETR for low tax firms, which will lead us to overestimate the amount of top-up taxes due. So if substance and QTI use are concentrated in low tax firms, our current model would underestimate revenue gains. The opposite holds if substance and QTI use are more concentrated among high tax firms, so firms that have a globe ETR above 15%, even without the SBTI safe harbor. In this case, we underestimate top-up tax revenue and consequently revenue gains from the GMT. Another caveat when we model the SBTI safe harbor is that we cannot distinguish the cause of low ETRs, and we also do not know to which extent the QTI cap is binding or not. The cap for the SBTI safe harbor is based on payroll depreciation of tangible assets. However, CBCR data does not contain any information on depreciation. So here again, we need to make an assumption. And what we do is we assume that depreciation is equal to 12.5%, informed by an average observed in firm level data from Orbis. These caveats have to be kept in mind when interpreting the outcomes. And as before, we try to reflect this underlying uncertainty in our outcomes by communicating bounds rather than point estimates throughout the result part of the presentation. With this, I will move to present the results of our economic impact assessment model. On the next slide, I will discuss the main results considered in our impact assessment. So in our analysis of the GMT, we consider the following 4 key outcomes. First, the impact on effective tax rates. Second, the impact on ETR differentials. Third, the impact on profit shifting. And fourth, the impact on tax revenues. On the next slide, I will talk a bit more about the impact of the GMT on ETRs, so on effective tax rates. Overall, we estimate that the GMT increases ETRs in most jurisdictions. The following graph shows the increase in ETRs at the jurisdiction level relative to pre-GMT ETRs. So on the x-axis, we can see pre-GMT ETRs for jurisdictions. On the y-axis, the absolute increase in ETRs after the introduction of the GMT. Each dot represents one jurisdiction, and different jurisdiction groups are denoted by differences in colors and shapes. The line shows the relation between pre-GMT ETRs and the increase in ETRs. And we can see that this line is downward sloping. So overall, there is a negative relationship between ETR increases and pre-GMT average ETRs. So ETRs increase most strongly in jurisdictions with low pre-GMT ETRs, which are mostly investment hubs indicated as green diamonds on the left-hand side of the chart. On the right-hand side of the chart, we can see that the increase in ETRs is low for jurisdictions with high pre-GMT ETRs. It's important to note that the introduction of the SBTI safe harbor further concentrates ETR increases in jurisdictions with low substance, such as investment hubs, since these do not benefit much from the safe harbor given the design of the cap. On the next slide, I will show results for the second key outcome that we considered in our model, the impact of the GMT on ETR differentials. The chart shows the distribution of ETRs on the jurisdiction level. On the x-axis, we can see the average jurisdiction level ETR. On the y-axis, the density of jurisdictions at this ETR. The gray distribution shows pre-GMT ETRs, while the blue distribution shows ETRs under the current GMT rules. And the dashed line indicates ETRs of 50%. We can see that the dispersion of post-GMT ETRs, so the width of the distribution, is much lower than the width of the distribution of pre-GMT ETRs, so the gray distribution. After the GMT ETR differentials, so the difference between the 25th percentile and the 75th percentile of the ETR distribution, are 19 to 25% lower than before the introduction of the GMT, which we can also see reflected in this narrowing of the ETR distribution. The post-GMT distribution is modestly impacted by the side-by-side package, which can be seen by the fact that post-GMT ETRs are now less concentrated at 15%, the dashed line, than in previous estimates. This is largely driven by the introduction of the SBTI safe harbor. Further, even after the GMT, some ETRs remain relatively low since some low tax profit is protected through the SBIE, which Piers has already explained a bit. It's important to note that the reduction in tax rate differentials we see here will also reduce the incentive to locate profits in certain jurisdictions for reasons related to tax rates. And this may lead to more efficient allocation of capital, since in this case, pre-tax rate of returns will be more aligned with post-tax rate of returns. This will then reduce the incentive to shift profit, and which my colleague Felix will now speak a bit more about.
Yeah, thank you, Laura. So I will continue with the final 2 dimensions of the results from our EIA model, the impact on profit shifting and the revenue effects of the GMT. And I will start with the profit shifting effects on that slide. As Laura has just explained, we expect the GMT to reduce effective tax rate differentials between jurisdictions. And as these differentials narrow, so does the incentive for MNEs to shift profits towards investment hubs, just because the tax advantage from doing so is reduced. The chart here then shows the estimated gains and losses in terms of tax base that results from the changes in profit shifting. And those gains and losses are always expressed as a share of total profit that are reported in the different jurisdictions before the GMT. The results are also split by income group, with the investment hubs separated out at the right. According to our estimates, all of those non-hub jurisdiction groups are expected to gain in tax base since there's just less profit that is shifted out of those jurisdictions. And these gains tend to be somewhat larger for lower income jurisdictions since they are often particularly exposed to profit shifting. By contrast, investment hubs are estimated to experience significant tax-based losses since they just receive less of the shifted profit. So overall, our results point to a substantial reallocation of reported profits away from investment hubs and towards other jurisdictions. And this reallocation also results in higher corporate tax revenues at the global level because the profits that are now remaining in non-hub jurisdictions are on average taxed at higher rates than they would have been taxed at in the investment hubs. As Laura has explained as well, those estimates already account for the potential effects of the SBTI safe harbor. So because of the design of the substance cap, the ETRs in jurisdictions that have greater economic activity also tend to be less affected by the GMT now than it was the case before the introduction of this safe harbor. And that then implies that there's a relative increase in the competitiveness of substance-heavy non-hub jurisdictions in comparison to investment hubs that have low pre-MG rates and little substance. And second, our results account for the side-by-side safe harbor and the associated assumptions, which are a more limited reduction in profit shifting by US headquartered MNEs. The next slide then turns to the revenue implications of the GMT. So figure again shows the results by income groups. And what we have here are the estimated increases in corporate tax revenue relative to CIT revenues before the GMT. The estimated revenue gains combine what we call the direct revenue effects, so the effects from top-up taxes that are collected through QD entities, IIRs, and also the UTPR. And we have the indirect gains, which result from reduced profit shifting. The uncertainty ranges that we show here are relatively wide, and they're also somewhat wider than in previous versions of our modeling. And that reflects the additional uncertainty that is associated with the modeling of the SBTI safe harbor, since we only have very limited information on the availability and the use of qualified incentive. In the chart, we have the blue bars that show the baseline scenario, which is based on current implementation as of June 2026. And we have the green bars, which show an illustrative scenario that assumes global implementation of the GMT in all jurisdictions that are outside of the side-by-side safe harbor. In terms of key findings, we estimate that the GMT, under its current design and implementation, increases global CIT revenues by between 3.2 to 5.4% of current CIT, and that corresponds to around 91 to 155 billion US dollars annually. Revenue gains are estimated here for all income groups. So while we expect that there are increased CIT revenues for all groups, the distribution of those gains across the jurisdictions within the groups critically depends on which jurisdictions implement which parts of the rules. So the more jurisdictions that adopt QD entities, the less revenue is collected through IIRs in headquarter jurisdictions or through the UTPR. And the more revenue is collected locally, where the underlying profits are reported in the first place. Under current implementation, the gains tend to be larger for high income jurisdictions, which is reflecting the higher level of implementation in that group. If we then turn to this scenario that assumes global implementation, so in which all jurisdictions have QD entities on low tax profit reported into their territory, we assume that high income jurisdictions would gain a bit less, but at the same time, the lower income jurisdictions would benefit disproportionately as they would gain from higher QD entity adoption. So in other words, under current implementation, some lower income jurisdictions are leaving money on the table, and that money is instead collected by other jurisdictions through IIRs or UTPRs. To help developing countries to realize this revenue potential, the OECD and partner organization are providing support to developing jurisdictions that are implementing the GMT at the moment or considering doing so in the future. A first key step here is often to help countries to conduct an own economic impact assessment so policymakers can identify the implications of the GMT in concrete terms in light of their specific circumstances, not just based on a high-level estimate, but really based on their domestic data. Beyond this kind of analytical support, there's also a wide range of capacity building activities. There are training programs, technical assistance programs, guidance materials, implementation tools, which are designed to support legislation and the practical administration of the rules. And finally, This next slide shows that the revenue estimates, revenue estimates when we also consider the effects for investment hubs here at the bottom of the slide. And the results suggest that at least in the short run, investment hubs experience high revenue gains from QDMTT implementation. And that's driven by two factors. First, there just is a relatively large share of global direct tax profit that is currently reported in investment hubs. And where these jurisdictions implement QDMTTs, as some of them do, they may collect relevant top-up taxes. And second, the results here are expressed relative to pre-GMT CIT revenues. And those pre-GMT CIT revenues are often very low in investment hubs today. So even kind of a moderate increase in tax collection translates into very large percentage gains. And that's exactly kind of the effect that we see here. At the same time, the revenue effects for investment hubs have to be interpreted with some additional caution. The EIA model does not account for potential changes in the location of real activity due to changes in competitiveness. So resulting adjustments could affect both revenue outcomes and also the broader economic activity investment hubs, particularly over the longer term, but these effects are not part of the model. That now concludes the first part of the presentation, which summarizes the results from our comprehensive update of the EIA model. So let me now turn to some early evidence based on post-implementation data. So we believe that the results from the EIA model remain highly relevant going forward because many of the effects of the GMT will take years to unfold. But we now had a first opportunity for an assessment of post-implementation financials. So the analysis that we present in this section is a completely different methodology, completely different data source. And the idea is that it can complement kind of this predictive EIA model. We will also publish a working paper alongside this webinar, which summarizes the results from this ex post assessment in more detail. That working paper is joint work with Lucia Contreras and Tom Zawisza, and it will be published, I think, now. So over the last month, financial data from the first post-implementation year, so 2024, became increasingly available. And for us, that creates the opportunity to move beyond the simulation of this EIA model and to examine the impact of the GMT on in-scope MNEs based on realized financial outcomes. So we move from an ex-ante to an ex-post analysis. It also allows us to switch from this highly aggregated model to a more granular MNE level perspective. And since there has been some time between the announcement of the GMT agreement, which was in late 2021, and the start of the implementation in 2024, the data that we have can also be used to assess whether MNEs have already adjusted their behavior in anticipation of the reform before 2024. Now, there already exists a large body of academic research that assesses how MNEs respond to taxation, and in particular, how they respond with investment. But most of those studies relate to unilateral reforms, so reforms where only one country changed their tax environment. The GMT is an unprecedented, coordinated, and multilateral reform. So we believe that the effects might be quite different, and that's also making this study particularly valuable. In terms of methodology, we used what is called the difference in differences approach. And in this approach, we compare the development over time for MNEs that are in scope of the GMT with the developments of similar MNEs that are not in scope. Under certain assumptions, the estimated effects from such a methodology can then be interpreted as causal effects of the reform. In terms of outcomes, we focus first on the effect of the GMT on ETRs at the MNE level. So the key question here is whether the GMT has achieved the objective of raising the taxes paid by previously low tax MNEs. And second, we assess whether the potential changes in effective tax rate could also imply changes in total investment or employment of in-scope MNEs. So the next slide provides more information on the data that we use and the identification strategy. In general, our analysis draws on Orbis data, that is financial data that is consolidated at the MNE level. So the MNE level is the level of observation in our analysis. The sample here covers the years 2016 to 2024. So we have 5 years of data before the GMT agreement in late 21. We have 2 years of data between the agreement and the implementation, and we have this first post-implementation year. To identify the effects of the GMT, we exploit the 700 million euro revenue threshold, which determines whether an MNE is in scope of the rules or not. And this threshold provides a quasi-experimental setting which we can exploit in the difference in differences approach to identify the effects of the reform. The figure here illustrates the basic idea of this identification strategy. So what we do is we compare MNEs with revenues that are just below the revenue threshold, that are then the control group in our assessment, with MNEs that are just above the revenue threshold, which form the treatment group. Then there are additional upper and lower revenue bounds which we apply, which help to improve the comparability of the two groups. And in addition, we exclude MNEs that are very close to the 750 million threshold. That helps to improve the stability of the assignment to the groups over time, and it reduces concerns that could be related to self-selection into the groups. The assignment of the MNEs into the groups is based on their 2017 to 2019 average revenues and MNE status. And the advantage of that is that it ensures that the group assignment is entirely based on information that was determined before MNEs could respond to the reform. The next slide then has some additional details. So we construct a baseline sample for our estimate, and that baseline sample focuses on non-financial MNEs. The issue with financial MNEs is that their accounting revenues do not always align with the revenue concept that is relevant for the GMT, and that could lead to issues that is related to the assignment to the treatment and the control groups. We also entirely exclude the shipping sector, since that is generally outside the scope of the GMT. And finally, the baseline analysis focuses on MNEs that have below median ETRs in the 2017 and to 2019 period, since that's the MNEs that we think have low tax rates and are actually affected by the GMT. In the resulting baseline sample, the MNEs in the treatment and control group differ in terms of size by construction. Right? You compare somewhat small MNEs with somewhat larger MNEs, but they are highly comparable across other key dimensions, so including industry composition, pre-reform ETRs, and also growth trends. In the regression analysis, we then also include a number of control variables to account for potential confounding factors. That includes MNE year and industry times year fixed effects. We also add controls for the impact of the economic cycle or reporting artifacts. The different choices that we have made there in terms of the baseline sample and the controls are also tested in extensive robustness checks. So with the methodology established, I would turn to the first set of results, looking at the impact of the GMT on effective tax rates. The figure here presents the coefficient estimates for the treatment effect of the GMT for each year. So we go here from 2016 to 2024. The gray vertical lines that we have indicate the 95% confidence intervals around the point estimates. And we think that there are three findings that really stand out. So first, there's no statistically significant difference between the treatment and the control group in the pre-announcement period, so up to 2021. So the zero is always within the confidence intervals. And that indicates parallel free trends, and that is a key condition for the validity of the approach to really identify causal effects. Second, we do not see any statistically significant effects following the 2021 agreement. So there's no evidence of a measurable announcement effect in 22 or 23. And finally, the key results then appears in 24, so following the implementation of the GMT. And our estimates indicate that effective tax rates for in-scope MNEs increased by approximately 1 to 2 percentage points relative to the control group. The baseline estimate, so focusing on the lower taxed MNEs, is an increase of around 1.7 percentage points in ETR. That's roughly a 12% increase relative to the pre-reform mean ETR of those MNEs. Additional analysis then shows that this increase in ETRs that we observe really reflects higher tax payments and not just changes in pre-tax profits. Since the effects that we describe here are impact on consolidated ETRs, so ETRs at the MNE level, they include both direct and the indirect effects of the GMT. So we have both top-up taxation and reduced profit shifting that can contribute to those higher ETRs. We are not able to disentangle between these effects in the analysis. Nevertheless, those estimates provide some of the first direct empirical evidence that the GMT is affecting the tax outcomes of the previously low-taxed MNEs in the intended direction. So the next question that we then study is whether these higher ETRs are also accompanied by changes in total investment or employment. So this slide here then contains the same type of chart that we have just presented for ETRs, but what we show here now is the effects of the GMT on investment, that's in panel A on the left, and employment in panel B on the right. And as before, we observe parallel pre-trends in both charts, and there's no statistically significant announcement effects. What's different compared to the findings on ETRs is that the coefficients also stay insignificant for 2024. So we find no statistically significant change in investment or employment after the introduction of the GMT. Potentially, that could be due to the multilateral nature of the reform or the design of the GMT, which focuses top-up taxes on excess profits through the substance-based carve-out. But at the same time, it's also important to keep in mind that the analysis only focuses at group-level investment. So only because we don't see an aggregated effect, it doesn't mean that there is no reallocation of activity across jurisdictions within the MNE groups. And finally, we have some initial analysis on MNE structures, which shows that there is no significant effect of the GMT in 2024 as well. So we do not observe, for example, a reduction in the total number of subsidiaries or a reduction in the number of subsidiaries that are located in investment hubs. The final slide here then summarizes a range of additional results from the ex-post analysis. So first, we have conducted a large number of robustness checks on the results. And those results that I've just presented are broadly unchanged if we include additional control variables in the regressions, if we use alternative revenue bounds to define the treatment and the control groups, or if we use, for instance, a balanced sample. Second, we have conducted a couple of placebo tests to confirm the validity of our identification strategy. For example, we applied exactly the same methodology on firms that are outside of the scope of the GMT, such as non-MNEs. And if we do that, it produces null results as it should. And similarly, we also get null results if we use placebo treatment years. And these placebo tests strengthen the confidence that we have that the observed increase in ETRs is actually related to the GMT. And finally, we assess whether the effects differ across different types of MNEs. And what we find there is that the effect on the ETR, so the increase in ETR, is stronger for MNEs that have a greater propensity for higher tax aggressiveness, for MNEs with a higher profitability, and for MNEs which are headquartered in a jurisdiction that has implemented an IIR. At the same time, for all of those groups, and despite the stronger ETR increase that we see, we continue to find no statistically significant effects on investment or employment for these subsamples. So taken together, those early results from ex-post analysis suggest that the GMT has raised effective tax rates among affected MNEs, but is not associated with a measurable reduction in investment or employment at the MNE level. Of course, you need to keep in mind that the analysis only considers the first year implementation, so the findings need to be interpreted as short-run effects. And with that, I hand back to Piers.
Thanks, Felix. So we're almost done, and thanks, Felix and Laura, for going through those results. So from my side, I'll just wrap up by reviewing the key results that we've seen today. So turning first to the update of the impact assessment model, just trying to bring everything that we've seen and heard together. We find that the effective tax rates as a result of the application of the minimum tax, this is including the side-by-side looking forward. We expect that effective tax rates will increase. We expect that because those effective tax rates are going to increase, that the gaps between in the effective tax rates levied in low tax jurisdictions and those levied in high tax jurisdictions are going to fall. We think that that's going to improve potentially the allocation of capital worldwide. Again, because the gaps between low tax rates and high tax rate jurisdictions are going to fall, we also assess that there's going to be reduced incentives to shift profits. And so we find that profit shifting is going to fall after the application of the minimum tax. We are not saying that that is necessarily going to happen immediately. That is the kind of results that may take time to materialize as MNEs change their behavior. And from all of that, together with the shifting, the reduction in profit shifting, but in addition also directly from the application of the global minimum tax itself, we expect that global tax revenues are going to rise. So I think it's useful maybe to just quickly reflect on why after the application of the side-by-side safe harbor and the substance tax incentive safe harbor, we still find many of the key results in terms of the key goals of the minimum tax being preserved. In terms of the side-by-side safe harbor, it's worth mentioning, first of all, that the US itself has several different minimum tax-like features in its existing system. So that's the US county system, the US necktie system, the Subpart F branch. All of these features limit the extent to which US MNEs can have global low tax profit. But it's also important to note that US MNEs will remain subject to the global minimum tax as outlined in the GLOBE rules in many countries, foreign countries where they do business, where those QDMTTs are in place at the moment. And as we saw, those QDMTTs are in place very widely, including in many major investment hubs. So that's a key reason why, even in the presence of the side-by-side safe harbor, you're still seeing many of the key policy goals of the global minimum tax being preserved. In terms of then the substance-based tax incentive safe harbor, we again find that the impact of the substance-based tax incentive safe harbor is does not materially impact the extent to which the global minimum tax reduces BEPS, and that's because the substance-based tax incentive harbor is exactly that. It's a substance-based tax incentive safe harbor. So where there's profits without substance, which might give rise to BEPS concerns, the substance-based tax incentive safe harbor is less generous because of the application of the substance-based cap, and that's a key feature. So if these tax incentives might be considered to give rise to profit shifting risks, there's a cap there that's based on substance that ensures that you cannot get low tax outcomes without that economic substance being there. We do find that the use of these substance-based tax incentives in jurisdictions where substance is heavy will potentially reduce the top-up tax revenue resulting from the tax. And so we don't have good data, as Laura already discussed. We don't really have good data on the extent to which these substance-based tax incentives are being used in jurisdictions today. And so we don't know how much the application of that safe harbor in those jurisdictions where there is economic substance might reduce top-up tax revenues. But we don't really see that they're going to give rise to BEPS risks because of the application of the cap that we've already discussed. So that's an overview of the key results from the forward-looking model, including the side-by-side package, so both safe harbors. And then turning then to the data from the 2024 financials. So these analysis, this is quite a separate piece of analysis that Felix discussed. It's based on 2024 data alone. So there's no side-by-side package in these data. And it's also based on a completely different data source and a completely different model to the results that were discussed in the previous slide, where that slide is focused on a model that's looking forward, that's incorporating behavioral reactions that may take time to materialize. This is really focused on 2024, and it's focusing on what has already happened and what is already visible in the 2024 financial data. So in that analysis, we're able to see an increase in the consolidated ETR, so the ETR at group level, of between 1 and 2 percentage points. And importantly, we're able to see that increase in effective tax rates is concentrated in firms that are more likely to be engaged in profit shifting. So that again highlights the effectiveness of, or is in support of at least the effectiveness of the global minimum tax in terms of reducing profit shifting. And importantly, we do not at the consolidated level see any as yet reduction in investment or employment. Now, of course, those are short-term effects. We have always said that the effects of the global minimum tax may only manifest themselves gradually. So it's important to take those 2024 results with a good deal of caution. But nonetheless, again, we think that that's important and interesting early results. Again, another reason why they may change, as Felix already discussed, is the fact that the global minimum tax is changing over time due to the changing shape of the SBIE, due to the application of the UTPR in 2025, and then due to the application of the side-by-side package in 2026. So for all those reasons, the two pieces of analysis are not directly comparable in terms of the estimates that we're seeing, but at the same time, it's interesting and helpful to see that the increases in ETRs, they're kind of a similar order of magnitude. And there's more details on that analysis in the working paper that's released alongside this webinar. So that, I think, concludes our analysis. And so we turn now to Q&A. We have quite a lot of questions in the chat. So I'm going to try and group a few of these and maybe pass some across to Felix and Laura. We had quite a few queries on whether we can provide more detailed results on where the revenue estimates are going. I think Laura and Felix went into quite a bit of detail there on the jurisdiction group results, trying to show where those revenue estimates would accrue. Of course, a lot depends on the implementation. We saw that already. We saw that implementation is lower amongst some developing countries, and that may mean that they may leave money on the table that might be collected by other jurisdictions. Felix, I think, already talked about the work that the OECD and partner organizations are doing to help countries implement relevant aspects of the minimum tax rules. In terms of more detailed results, we don't provide kind of jurisdiction-specific results, though many jurisdictions themselves do that. But we have always provided jurisdiction group results as part of this work. There was a question on the definition of shifted profit. I think that's defined in more detail in the working paper. I think it's profits in excess of a routine return on substance. But maybe Felix could speak to that more. We have a question then on why do we think that there are no effects of the GMT on investment? Maybe I'll let Felix discuss that one. Felix, if you want to talk that, and I'll try and collate some of the other questions. Do you want to talk a bit more about the investment impacts, Felix?
Yeah, happy to. And I guess in the question already the link to the academic literature was made, which typically suggests that an increase in tax really tends to reduce investment. So at first glance, I agree that the increase in ETR is combined with kind of a zero effect on investment that we find seems surprising. And of course, we have to keep in mind that our results are relatively early results. But I also think that there are a couple of important differences between the GMT and the settings that are typically studied in the literature, which may explain the differences in outcomes observed. So first, the GMT is a broad and far-reaching multilateral reform. So in other settings, MNE can respond to a unilateral tax right by just reallocating investment to another jurisdiction, and that might lead to those negative investment effects. But under the GMT, the benefits of such a type of reallocation might be more limited. And second, often the negative effect of taxes on investment is related to the user cost of capital. And if you think about the design of the GMT, which focuses top-up taxation really on excess profits through the substance-based carve-out, it could be considered as more of a rent tax. So from that perspective, the GMT can reduce the profitability of some projects on average, but it doesn't necessarily make previously profitable projects unprofitable. So it might affect more the average return on investment rather than the marginal investment decisions of firms, and that might be a design feature that could reduce the impact on investment. And I guess what also speaks against strong investment effects and strong effects through the user cost of capital is, while these are early results, the MNEs had several years to prepare for the introduction of the GMT. The announcement was in 2021, but we don't see any announcement effects. And I guess one last thing is that we do not find statistically significant results, but we cannot rule out small negative effects on investment. So we have a 90% confidence intervals. And our results suggest that kind of the end of this 95% confidence interval is a reduction investment of 1.1%. So this is still within kind of the possible responses. So there might be negative responses that are just so small that they are not picked up by our analysis. But in any case, what we think we can say is that the effects would be certainly much smaller relative to what would be expected in terms of the investment effect based on the literature. So it seems like the GMT is really very different compared to reforms that we have seen before.
Thanks, Felix. We have another couple of questions from Saul. One is whether the impact assessment covers OECD only or whether it's all of the IF. We cover, so our model covers more than 200 jurisdictions worldwide, so that's bigger than the IF, but the results presented cover IF jurisdictions, and of course we work closely with all of the IF members to try and provide these results to them on a bilateral basis, and then also to work with them to use their own data, especially developing countries with capacity constraints, as Felix already talked about. We work hard with them to try and help them understand what the application of the tax might mean for them. And then another question is whether we consider other measures taken by countries to defend their tax base other than the GMT, like revising incentives or adoption of domestic minimum taxes, not QDMTTs. And the answer to that is no. So we don't build that into our assumptions. So if the global minimum tax creates space for jurisdictions to either revise their incentives or to introduce non-QDMTT DMTs, that would be kind of extra revenue gains for those developing countries over and above what we model. But that's a good point, that there are a variety of different ways in which countries can act, and have potentially been given space to act by the presence of the GMT. It doesn't necessarily have to be a QDMTT. It can be those other policy responses like incentive reform, and we do work with those countries, with developing countries, to look at those issues. And we have, I think, several publications in the pipeline to try and describe that work a bit better. I'm looking at some other questions. We had another one. Sorry. We had another one on what is the difference between the ex post and ex ante analysis, and why are they not the same? I think that refers to the ETRs not being the same. Felix, do you want to speak to that as well?
Yeah, sure. I mean, it's a good question. So both analysis point in the same direction. We see in ETR increases through the GMT, but the estimated magnitudes are somewhat different, and they are a bit lower in the ex post assessment. I mean, I guess generally, if you have two statistical approaches, I wouldn't expect them to produce exactly the same results, since they all come with relevant uncertainty and all of their strengths and weaknesses. I guess in that case, there are a couple of reasons why the ETR increases might be smaller in the ex post analysis compared to the EAA model. I guess the ex post analysis at this point in time should be considered more of a short-term effect. So what we're observing are MNEs in the first year of the implementation. They are still adapting to the new tax environment. The ex ante EIA model is estimating kind of the longer run equilibrium in which MNEs have fully adjusted the behavior. So for instance, the profit shifting responses might become stronger over time as the MNEs gradually adjust their structures. And also the implementation of the GMT is involving. So in 2024, it was the first implementation year, but afterwards, additional jurisdictions have implemented elements of the GMT. The UTPR only became effective in 2025. The substance-based carve-out is kind of phased down over time. So the intensity and the coverage of the GMT itself are also expected to continue to increase after 24. And in addition, then there is the transition from temporary safe harbors to this agreed side-by-side package. So overall, I think it's not so much that the estimates are contradictory, but they answer kind of slightly different questions, with the ex post analysis telling us what really happened during the first year of implementation, and the EIA model takes kind of a longer run perspective on the effects under a stabilized policy framework. So it's possible that the ex post analysis also picks up in terms of size after a couple of years.
Thanks, Felix. And then I have another question from, I think, Thomas online, asking, how were the effects of the substance-based tax incentive safe harbor modeled, particularly since this safe harbor is not yet in effect? Laura, do you want to take that one? Yeah.
Sure, happy to answer that one. Yeah, as we already tried to make clear during the presentation, it's really difficult to model the substance-based tax incentive safe harbor in particular, because we don't have any information or very limited information on QTI availability and use. And so what we do for now is that we model the SBTI safe harbor as an increase in globe ETRs, which is caused by this add back to cover taxes. And given that we don't have any information on QTI availability and use, we make this add back to cover taxes depend on the cap that has been defined in the SBTI safe harbor. And we then make the assumption that either 10% of this cap is added back to the covered taxes, or that 60% of the cap is added back to covered taxes. So basically, this means that the effect of the SBTI safe harbor depends a lot now on where actual like substance is located, so where tangible assets are located and where payroll is located. And for these jurisdictions, we assume that they benefit more from the SBTI safe harbor due to this add back, even though this might not necessarily be the case. That this is something that we can only observe once the SBTI safe harbor is in effect and we have data to analyze this. However, the effects of the SBTI safe harbor materialize in our results, in particular when we look at the ETRs. So we can see that due to the SBTI safe harbor, there are still several ETRs these are non-globe ETRs, which remain to be below 15% simply because of this add back of substance protects substance heavy low tax jurisdictions. And the ETR in these jurisdictions through the GMT does not increase fully to 15%.
Thanks, Laura. We have another question. How do you assist developing countries that may have constraints in terms of data on incentives and revenues in order for them to carry about their own impact assessments? So we work very closely with countries to do this. There are also partner organizations doing a lot of work with a lot of developing countries to help them understand the minimum tax, both before and after the side-by-side package. So ourselves, the World Bank, the IMF, IASD, ATAF, a lot of other organizations are doing important work in that area. It obviously requires a lot of analysis in terms of trying to identify the in-scope taxpayers, trying to understand the level of substance, trying to understand the extent to which they benefit from tax incentives, trying to understand whether those tax incentives are qualifying tax incentives. So all of that work takes a little bit of time. We help countries either doing the data analysis themselves, or in some countries we use countries' own data and do the analysis and then provide them with that support. We also give countries kind of broader guidance about what kind of tax incentive reform they might want to consider in a post Pillar 2 or a post side-by-side package environment. So all of that work is ongoing. So now I'm looking for further questions. We had a question on how do the results differ from results published before the side-by-side package? So I spoke a little bit towards that at the last slide. Generally speaking, the results are slightly different. We tend to find that the impacts on low tax profit, the impacts on BEPS, reduction, the impacts on tax rate differentials, we find that a lot of those impacts are still there. They're a little bit reduced in some cases, but they're still there in the data. And that's because in terms of BEPS reduction, the side-by-side safe harbor has a relatively limited impact because first, the application of the US current system of foreign taxation, and second, the fact that QDMTTs are very widespread, including in many jurisdictions where US MNEs have low tax profit. So that's for that. And then in terms of the substance-based tax incentive safe harbor, we find again a relatively limited impact on low tax profit without substance and on BEPS risks because in that substance-based tax incentive safe harbor, there is a cap. So that limits the extent to which instances where an MNE is trying to have low tax profit without substance, the cap starts to bind. And that means that the MNE is less able to take advantage of the substance-based tax incentive safe harbor in instances where taking advantage of that might generate a BEPS risk. So that's important in terms of why the results are relatively stable. The revenue estimates are reduced. Much of that is due to the substance-based tax incentive safe harbor applying in jurisdictions where the substance is extensive. And so basically what it's doing in those jurisdictions is that it's allowing jurisdictions to use certain tax incentives to encourage certain kinds of substance. And that's really, I think, a kind of a policy choice by members of the inclusive framework who want to use tax incentives to encourage certain kinds of economic activity, be it R&D activity, green activity, other kinds of industrial policy, without giving rise to top-up tax, and then also without giving rise to BEPS risks, because you can only benefit from the substance-based tax incentive safe harbor where you have actual economic substance. So that's an overall overview of the differences between the modeling that we had before and the modeling that we have now. In addition to the various elements that Laura already covered, of course, we have more updated data. We have a longer C/CR time series, and we've also spent quite a bit more time trying to understand the US system in terms of modeling subpart F, in terms of modeling branch, and in terms of modeling GILTI and the changes from GILTI in the recent US tax reform. So that's an overview really of how the results have changed. There's a question here about why US CAMT was not included in the modeling. A little bit of that is due to lack of publicly available data that we could find, because CAMT is quite recently implemented. So we use the publicly available data for various parts of the US tax system to try and update our model. And that's one of the reasons why we didn't have that. There's another question on the domestic ETRs of US headquartered multinationals, whether low tax profit is due to SBTI. I think, Laura covered a little bit of this. It's quite difficult for us to understand the full extent to which substance-based tax incentives are driving low ETRs, because we don't know how many substance-based tax incentives there are. We do know that one of the major tax incentives in the United States, the R&D tax credit, is likely to be a qualifying tax incentive. So that's an important feature there in terms of what might be driving those ETRs. But again, it's worth noting, we don't have granular data to do this analysis. We're basing this analysis on aggregated and anonymized C/CR data, so that's always going to be a limited, a limitation on the granularity and the quality of the analysis that we can do. I'm looking through for further questions that I can ask. I don't know, Felix and Laura, if you've seen any that you want to come in on, please go ahead.
Maybe there's been one question on whether we see a fragmentation of large companies to avoid the GMT, which is a difficult one. And we don't have the data to make this assessment, but we have some evidence from CBCR, which uses a similar threshold. And what we see there is that there are companies that avoid kind of those types of requirements with a size threshold by bunching just under that threshold. In the context of CBCR, at least to my knowledge, there's not a large evidence base for fragmentation of large companies. There's a bit of evidence for companies that are just under the threshold that delay growth, so they avoid the jump over the threshold. But then they often catch up with the growth in later years. So clearly it's a different setting, but it's and the evidence is not yet there, but potentially some of the similar effects could be here as well.
Thanks, Felix. Looking at a couple of other questions now. Are you going to publish a more detailed and in-depth analysis on the impact regarding tax incentives? The answer is yes. We're going to do more work on tax incentives, trying to model the impact of different tax incentives and provide countries with some more guidance on what tax incentive reform might look like in a post-GMT context. So that's yes. And the answer then on have you modeled compliance costs? And the answer there is no, though there is some increasing literature on the size of the compliance cost, noting, of course, that the compliance costs are likely to be in very significant measure startup costs rather than continuation costs. There were a couple of questions on deferred tax assets. I'm not going to go into those in too much detail because they're relatively technical. We do our best to model the presence of deferred tax assets in the rules, and there's more about how we do that in the 2024 paper, and I think we've more or less stuck with that approach in the current set of results. with that, I think we've covered, I think, quite a lot of what was there. Yeah, there's some more detailed questions on DTAs that we probably won't go into. There's been some questions in the chat that aren't really relevant for the impact assessment itself, in terms of the process around qualified status and so on, that we won't speak to because they're more questions for our legal colleagues. Okay. With that, I think we're almost ready to wrap up. So let me thank again everyone for their attendance, and thank Felix and Laura for presenting, and also for answering all the questions, and also for all of the work bringing this model into being, and for all the work updating. I will also extend my thanks to our delegates from Working Party 2 on tax policy and statistics, who provided a lot of feedback on this work. And then maybe I'll just note from our com side that the working paper and the web announcement related to this are online, and a replay of this webinar will be available in 24 hours. So with that, I'll thank everyone and say goodbye.